All right, last video we just broke down Apple's fundamentals. Solid revenue, solid profits, and insane cash flow. But hold up, but does that actually mean it's a good time to buy the stock right now? Because let me tell you, a great company doesn't always mean a great investment. Today we're diving into valuation metrics. How to know if a stock is overvalued, undervalued, or just right. And we'll continue on with our previous case study so we can know if this stock is a buy or a sell. At today's price, let's go. You ever walk in a store and see a $50 hamburger and then think, what the hell? Well, that's exactly what happens in a stock market every day. A stock can be wildly overpriced or can be a hidden bargain. To figure it out, valuation helps you answer one question. Are you overpaying, underpaying, or getting a fair deal? All right, let's break down the 3 must-know valuation metrics that help you decide if a stock is a deal or if it's a ripoff. Number 1, we'll go with the price to earnings ratio or the PE ratio, the classic indicator. So the PE ratio compares a stock price to its earnings. A high PE could mean a stock is overvalued, while a low PE might mean it's cheap or a trap. So the formula of this is stock price divided by earnings per share. And the Apple's current PE ratio is 34.44 during this recording. And also, this is not a financial advice. The current PE during this recording of S&P 500 is 25.27. But that's actually high compared to this historical average PE of 16.14. So as you can see, the Apple's current PE ratio is higher than the market's. It's higher than the current PE ratio, and it's higher, way higher than historical average PE ratio. So is Apple expensive compared to the market? Based on a PE, it looks like it is, but let's look at other valuation metrics. The PS ratio, or price to sales ratio. It's revenue-based value check. Some companies don't have big profits, so instead of PE, we use price to sales ratio. So the formula is the stock price divided by revenue per share. And the Apple's current PS ratio is 8.19. So a lower PS ratio means you're paying less per dollar of revenue, but is Apple's PS ratio attractive? We'll go into the next metric. All right, to determine the discounted cash flow analysis, you can utilize the following sources and data. So we need first the Apple's free cash flow, recent FCF data as of December 31, 2024. Says Apple's free cash flow was approximately $98.3 billion, according to alphaspread.com. And then we have a projected free cash flow, forecasted growth. Analysts anticipate Apple's free cash flow to grow over the next 5 fiscal years with an average of unlevered free cash flow forecast of $142.9 billion, according to finbox.com. And then we got a DCF, based fair value per share. So valuation estimates, various financial platforms provide DCF valuations for Apple. We got AlphaSpread, estimates a fair value of $127.82 per share, indicating the stock is overvalued by approximately 42% compared to its current market price. And then we got Guru Focus, calculates an intrinsic value of $131.67 per share, suggesting overvaluation relative to the current trading price. And then we got valueinvesting.io, provides a DCF valuation of $206.64 per share. Note, DCF valuations can vary based on the assumptions used, such as discount rates, growth projections, and terminal values. It's essential to consider multiple sources and understand the underlying assumptions when interpreting these valuations. All right, based on everything we analyze, is Apple a buy, hold, or sell? So the PE ratio is 34.44. It's above S&P 500's average of 25.27. Apple is priced higher than the overall market. And then number 2, we got the PS ratio of 8.2. Investors are paying $8.20 for every $1 of revenue, which is relatively high. And then lastly, the DCF fair value estimate, we have $127.82 per share. Apple's current stock price is significantly higher than that, meaning it may be overvalued by 42%. So here's the deal. Apple is an amazing company, but at its current price, it might not be the best buy right now. If you're a long-term investor waiting for a dip or a market correction, might be the smartest move. Again, this is not a financial advice. I'm just trying to give you fundamentals. But if you're already holding Apple stock, it still remains a powerhouse as a business with solid fundamentals. Remember, valuations isn't just about one number. You need to consider fundamentals, valuation metrics, and market conditions before making a decision. All right, now that you know how to value a stock, what do you think? Is Apple a buy or is it overpriced? Drop a comment down below. And in the next episode, we'll talk about how to actually execute your trades like a pro so you don't overpay. Make sure to like if you learned something and subscribe if you want to learn more. And as always, for more investing, finance, real estate, and macroeconomics, let's all learn wealthy together. I'll see you in the next video.